Hey everybody, this is Brant. I've got the S&P 500 on a 2-hour chart here, and we're wound back to about mid-June, which is where we started to see distribution in mega caps. I bring this up because if you're familiar with my work, I've had kind of a macro outlook in phase 1, phase 2, phase 3. Phase 1 has been the rally since October of 2022. And as we move into phase 2, it was a change in character that we're kind of going to top and start to roll over. So if I just roll this forward, this chart forward, remember June, mid-June, right where we are now is where we started to see distribution in mega caps like Apple and stuff like that on 3C. Let's roll the chart forward. And what we start to get, and a lot of people didn't want to see this or didn't want to, it just seemed cliche, to talk about head and shoulders tops, but we're seeing a head and shoulders top, and with a classic head and shoulders top, I mean, let's just look at what we're actually talking about. You're talking about an intermediate trend. So here is March, so we have a low there, and we have a higher high, and we make a higher low, we make a higher high. And by the time we get to the head of the head and shoulders, we don't really know anything is up yet, but on this pullback over here, typically what we're not seeing is a higher low. Usually a head and shoulders has got kind of a flat neckline. Some of them slope up, some of them slope down, but we're not seeing a significant higher low over here. And the way we confirm that is the next rally, which is the right shoulder, and we're not making a higher high here. So we're starting to see a market that is basically going from making higher highs and higher lows to not making higher highs and not making higher lows. And that's a change in the market trend. And our call, my call, was a head and shoulders top back here in August was likely, and that's what we have. Not only do we have that, we had it in a lot of places, but if we roll forward into time, what we're seeing is a sub-intermediate downtrend, and I'll show you that a little bit more. But the head and shoulders top is broken. Here's that, when I said, is the market too bearish? That was right over here, where sentiment was really bearish, and we got this little bounce right up to about that 4,400 area that I expected. Did not fill that gap. That's bearish. So we are within 0.1% of the measured move. There's a measured move area. It's not an exact level. So between 0.1% and 0.5% away from having fulfilled that measured move. And of course, it's not just the S&P, but the Dow Jones Industrial Average. And by the way, this vertical line is the measured move. So for the Dow, it's less than 1% from that measured move, which is in that 32,000 area. I would guess 32,000 is probably going to be a magnetic level for price. Here's small cap IWM, and a lot of times small caps will lead. So if we're going to go into like a new bull market, they'll usually be the ones to rally first. If we're going to head into a new bear market, they're usually the ones that will break down first. That's the measured move. So from that head and shoulders top, it's hit that measured move and it's exceeded it. You can see a bearish triangle consolidation here. So you have one leg down, consolidation, another leg down over here. Here's the NASDAQ composite. Again, another head and shoulders. It's broken down. It's headed down towards that measured move. I'd probably guess because it's so close to 12,000, 12,000 is a whole number, psychological magnet. That's probably going to be the target level. They're in all of the averages. NASDAQ's held up the best just because mega caps have been the only game in town this year. But they're also in a lot of key sectors. We'll look at some of those, but like home builders. And head and shoulders tops, by the way, they don't always look like, textbook examples or cherry-picked examples. But again, here's a head and shoulders top, and it's already fulfilled that measured move. This is a back test over here. It's really common. That's what we saw with the S&P as well. So let me pick up real quick from 2 videos ago, which was right back here when I asked, is the stock market too bearish? This was the video here, is the stock market too bearish, just because it was really oversold in sentiment. So we're talking about not is the stock market too bearish in terms of the macro or anything like that, but just short term, because nothing moves in a straight line in the equity market. I'm going to show you something. This is about where I said, is the stock market too bearish? And I was looking for that bounce up into 4,400. That's also a back test of a broken head and shoulders top. It's really common to see. And as I say often, very often, tops are a process, not an event. Like people think of a top being like a market crash. That's generally not how it goes. It's kind of like a slow rollover. It's a process, not an event. But if we go to this other set of trend lines, so I said we had an intermediate uptrend from last October 22, and that pretty much ended right here with the key reversal day. I think that was July 27th. Yep. Now what you'll see is a sub-intermediate downtrend. You can already see the lower highs, the lower lows. I'm going to go to this set of trend lines, and you can see that here. So when I said the stock market too bearish, we're basically at that point just bouncing off this lower channel into the higher channel, and now we see it kind of breaking down. And I'll get into why it's breaking down. Some really important events happening this week with earnings with the mega caps. But notice, ever since that key reversal day, and I did a video back then about this key reversal day, how important it was that it was right at 4,600, right at the top of the head and shoulders pattern. It's right there. And ever since then, we're in a sub-intermediate downtrend. There's also this little known rule. It's little known because we don't have inflationary environments very often. The last one was 4 decades ago. But it's kind of a rule of thumb. It's sell the last rate hike. So the last rate hike was actually right here, July 26th, and then 27th we had the key reversal day, and we've been in a downtrend ever since. So that's a interesting little thing that, you know, I've never seen in my investing career. I've been doing this about 25 years, and it's been about 40 since the last time we had an inflationary environment. But sell the last rate hike, there it was. So the very next day, we started this downtrend. So as I was saying, the big development this week was that we had a lot of mega caps reporting, most of them, in fact, and the mega caps have driven the market all of 2023. They were really hated in 2022, but they've been the standout winners in 2023. And they've actually been supporting the market to a large degree, just holding up better than a lot of stuff. But like I said, back in June, we were seeing distribution in 3C. I'll get into that a little bit more in a minute. So if we look at Meta platforms, which used to be Facebook, of course, you can see this solid uptrend right until June. Then we come into July, and it's kind of been a sideways market. And this is what I'm saying. The mega caps haven't broken down. They've been holding the market up still. But the trend definitely did change after June, after that distribution. And distribution is the process of smart money or institutional money selling into higher prices. They don't want to sell into a crash. They don't want to sell into lower prices. They want to sell into demand. Here's Amazon again. You can see from January when they rotated into leadership, but you can also see that recent break of the trend over here. Nvidia's held up a lot better because of this whole AI narrative, but you can also see a similar thing like we saw in Meta or Facebook. But this 475 area, we identified it back here as problematic, and it's been problematic. But you can see now, you know, the trend is turning more lateral, and we've actually gotten some really ugly price volume last week over here on down days. Here's Apple, which you can see was in a really solid uptrend. It was one of the first stocks we actually saw distribution in 3C mid-June, right? So if you look at what's happened here, it's in its own little sub-intermediate downtrend, making lower highs, lower lows. Apple's actually 10% lower right now than it was in mid-June when we started seeing institutional money moving out. And here we go with Microsoft. You can see the uptrend. You can see the break of it, and it's just back testing that uptrend. But if you look at the price trend over here, it's just slightly down. So this has been holding the market up, but it hasn't been driving the market higher. But with earnings this past week, seen some very unfavorable reactions in a lot of the mega caps. The most notable one in market general, it's Alphabet, Google. You can see that nice steady uptrend, and then this week the earnings, just a horrible break in that trend in Google. So this is where we're starting to see a real significant change in character this last week in the most important stocks that have really been driving the market all this year. And if we look at Google on a daily chart, I just want to show you something. Watch what happens with this volume on the break. So this is what institutional money does not want to get caught up into. They don't want to get caught up into selling into a down market on heavy volume like that, because it's all supply. They want to sell into demand. So that's what we were seeing in June. Like I said, Apple is already 10% lower than where we first started seeing distribution. First, that's when they just started. But this is a bad break on heavy volume. And of the three S&P sectors that are really heavily weighted towards those mega caps, the tech sector, so you can see its head and shoulders here and how it's been lingering along this neckline, but you see the trend is no longer up, but it's sideways in this topping process. And again, a top is a process, not an event. Consumer discretionary is another one full of mega caps. So you got Tesla in there, Amazon. That one had already broken down. You can see the back test and kind of like a little bear flag over here. But the one that was holding up the best was communications. It was staying well above this neckline until this week. So it was trading up here. So this week we see it break down. And again, if we look at the daily chart, you can see the break in price. But what's really important here is the volume. I mean, look at the size of the selling here in this volume as it breaks that neckline. And that is exactly what you should see when a Head and Shoulders top breaks its neckline like that. So heavy, heavy selling. And this is why, like I said, institutional money was getting out over here, basically the same area, but they were able to sell into price strength, not forced to sell into price weakness. So I read somewhere, I think it was Bloomberg, over the last 2 weeks, the mega cap stocks, the Magnificent Seven, have lost something like $1 trillion in market cap over the last 2 weeks. And now all those other averages that we're seeing breaking down, like small caps has already met the downside measured move. Dow Transports has already met the measured move. Dow Industrials has broken down. The NASDAQ 100 was holding up well because of its cap weighting and because of all the large cap and mega cap tech stocks in it. Here's NASDAQ 100. What do we see this week? A nice lower low breaking down from this neckline, because you can see prices just kind of been lingering around it. There's a bear flag back testing into it, and here's that breakdown. So we have one leg down here, a bear flag, another leg down here, and we still got quite a ways to go on this measured move downside target because the mega caps have been holding up so well. So that is the big change that we saw this week, is the mega caps really starting to give up the ghost. The one thing I can't account for right now, I mean, all these Head and Shoulder tops were in place well before anything happened with Israel. We were already heading in this direction. The uncertainty of that war is not a good thing for the market. So there's this phrase or saying in the market that when the missiles fly, it's time to buy. And when you just hear it at first, you think, well, the only reason that would make sense is because you have to produce more goods for war, and that would help the economy. But that's not actually it. If you go back to when Russia invaded Ukraine last year, the market was selling off right before, and then as soon as Russia invaded, the market got a decent bounce. What it's about is uncertainty. The market hates uncertainty more than anything. So the uncertainty of the war is what the market hated. Once the war actually started, the market rallied. So when the missiles fly, it's time to buy. The problem is with this particular war, there's a lot of uncertainty. So Israel obviously is stepping up the campaign in Gaza as far as prepping the battlefield with a lot of aerial bombing, moving ground troops and stuff into place. So that presents a lot of uncertainty. We had Turkey's president said something that appeared to be a threat that he might intervene on Gaza's behalf in a pro-Palestinian speech over the weekend. Iran conducting war games right on Lebanon's border. So there's a lot of uncertainty around that war, and I'm not a geopolitical analyst. I can't account for that. And I'm not going to be a news source of, what's going on in the latest of the war there. But we're looking at what Price is telling us, and Price is telling us that we were going to see this weakness regardless. But the one area that we're really seeing benefit from a flight to safety is gold, and it probably will continue to benefit. So let me pull up gold real quick. And what we have is a 2-hour chart of gold futures here, and the white line is 10-year Treasury futures. And what I've been telling subscribers and on these videos since March of last year when the Fed started hiking rates, gold and stocks have had a really strong inverse correlation with yields. Gold more specifically with real yields. So because yields move opposite of stock or of bond prices, you can see this positive correlation with treasuries, with the 10-year Treasury futures here in white. So gold has been more faithful to that correlation than stocks have been. Stocks will kind of run away from it a little bit and then come back down. But you can see over here, this is the flight to safety. This is where Hamas first invaded Israel, and we saw this big flight to safety in gold the very next day. So since then, and you can see on big volume too over here, we've seen some really bullish price action. So here's a bullish consolidation, here's another bullish consolidation, and then you can see this bullish ascending triangle right here, right at 2000, right? So as everything stepped up towards the end of the week, watch what happens to gold on Friday. You can see it breaks out. But this is what the bullish consolidation was telling us anyway, right there at 2000 psychological level. So it was holding there. It was waiting for the next bit of bad news out of that region. And you see a flight to safety bid there. So it's probably going to keep supporting gold, even though gold is really disconnected with real yields right now. So let's talk about heading into next week. I haven't even checked the news about what's going on over there because, you know, I could record this video and one thing's happening and then when I'm done with it, something else happens. I'm not going to put my analysis out that way, but we do have just a little bit to go between 0.1% and 0.5% to meet the measured move of this head and shoulders top. Usually what happens when you hit that measured move is that price will stop and consolidate. Sometimes you get a dead cat bounce, but generally it does something in the area of the measured move, some kind of consolidation. So that would be my first call. But that also means we have a little bit more downside to go, probably early in the week. As far as this channel goes, there's a concept that I have kind of named myself, and I call it a channel buster. So when we get a really deep kind of break of a channel like this, sometimes it acts like a rubber band and it slingshots prices back up this way. So imagine you're a short seller and you're seeing this channel break down, you get really excited. Okay, we're getting ready for a crash because this channel is breaking down, and then prices move back into it. Then those shorts cover and they kind of add upside momentum. You get this slingshot. So channel busters are common, and we're getting to an area where that could be a higher probability. I don't think we're quite there yet. But I could tell you, like, breadth oscillators are really deeply oversold right now. If we look at sentiment, the last time we saw sentiment this low in extreme fear was early October back over here. It was at 18. I think it's at like 24, 25 right now. So sentiment is getting really bearish again. And that's not to say a lot. I mean, the last time we got down to this kind of extreme fear level, we got basically a 4% bounce in the S&P up towards that 4,400 level. But we can see sentiment moving into that extreme fear. And the reason that that's important is because when sentiment gets to extremes, it's often a contrarian signal. So our extreme greed over here was actually when the market topped out at that head and shoulders top and actually turned lower. So a lot of times when you get to these real extreme sentiment readings are actually contrarian for the market, at least in the short term. And remember when I told you that gold and stocks have had a very strong inverse correlation with yields. So yields move higher, they move lower, which means that they have a strong positive correlation with bonds. So right now we're looking at the NASDAQ 100. Remember I said gold is a little bit more faithful to that relationship, except now that it's got the safe haven bid under it. So we can see areas, you know, where the NASDAQ 100 would rally away from that correlation and then just be brought right back down like a magnet. Or over here, you know, rally away from it, be brought back down like a magnet. This was our last one where I said the market was looking a little too bearish in the short term. We got this rally over here, and this week brought right back down to that correlation. But if we take a little bit closer look, like on this 30-minute chart, and again, you can see that it's actually higher yields that are leading the market lower. But if we look over here, we can see kind of we're not making higher highs in yields right now. So the NASDAQ has pretty much caught down to the medium-term correlation. Longer term, it has a lot more to go. Here I have the S&P 500 in that inner or sub-intermediate downtrend channel. And I have high yield credit HYG, which is one of my favorite leading indicators as far as a market-based leading indicator because institutional money uses it, but it's also sensitive to rates. So you can see as we bounced, this was that area in early October where it says the market getting too bearish. We got the 4% bounce to the top of the channel, and there's 4,400. At this point, we can already see high yield credit leading the market lower over here. It was pretty much, that was as far as we were going, and we've seen the market catch down around 4,200. The two kind of caught down to each other, and now high yield credit is starting to positively diverge a little bit too, so that's a little bit helpful in the short term, but I think we still have a little bit more downside. And again, these aren't huge signals, but they are a little bit more supportive. And when I say supportive, I'm talking about in the short term. Like I said, nothing moves in a straight line. And this S&P chart, again, this is a 2-hour chart, but this is that sub-intermediate downtrend that we've seen since the Head and Shoulders top. So again, we have a downtrend, but it's not a straight line, right? We get bounces, we get declines, we get bounces, we get declines. So these are very important in positioning. So you want to have a strategic view of what's going on, but also tactically you want to know, where do I want to short? I want to short here. I want to short here. I want to short here. I don't want to short here. And one other thing I'll show you real quick is a change in character we're seeing on some 3C charts. So here's a short-term chart of SPY, and you can see 3C is either leading lower, it's leading price lower, or it's confirming the downtrend in making its own lower highs and lower lows. But towards the end of the week, this is really the first even slight positive divergence I've seen, and this was really at the end of the week here on Friday, just kind of the last half of the day. Nothing that I'd really get excited about, but again, we always look for changes in character, because changes in character are what precede changes in trend. The market very rarely just changes trend without giving you some kind of a warning, a change in character. That's what we look for. Here you can see QQQ, and again 3C over here is either leading price lower or it's confirming lower until we get into the end of the week over here. Now, sometimes these kind of positive divergences on these really short-term time frames just lead to like a consolidation, like a bear flag or something like that. But I would give the award for most improved this week to QQQ, and it was just the last couple of days of the week. And here's the diamonds for the Dow, and you can see again 3C either leading or confirming lower, but we do have a relative positive divergence there. Again, it's nothing I would get real excited about. It's just something that's on our radar to watch. It's a change in character. And this is a little bit longer trend time frame, 3 minute for IWM. Remember, IWM has already met its downside measured move, which was around 166. You could see 3C actually leading price lower, confirming the downtrend the whole time. But over here, we start to get a relative positive divergence. And where does it start? It starts right as IWM is moving into that 166 area, that kind of downside measured move target. So that's kind of interesting. As we get near that target, we're starting to see a positive divergence, or at least a relative positive divergence. I think it's maybe a little bit too early to look for a bounce. S&P, I think, probably fulfills its downside measured move. A couple other ones that are close maybe do the same. But we are, again, seeing some changes in character. And don't forget that next Wednesday we have the Fed, the FOMC meeting. So the market, sometimes it just kind of drifts into that. But what all this means when we look at it from the bigger picture is that this rally from last October, October 22, where we've had higher highs, higher lows on an intermediate term basis, has now turned. And what we're starting to see now are lower highs and lower lows. So this is the start of basically phase 2. And my call, way back at the beginning of the year, was that we would probably see that start at the end of the second quarter, which was the end of June. We just happened to see distribution starting in mid-June, and then these tops, coming into play. So my call, from a larger perspective, is that this is just kind of the start of this trend change that we're experiencing. Phase 2 is more about a much more bearish recessionary market, and then phase 3 will be when everybody hates stocks, nobody wants to buy stocks, and I say I think this is a great time to buy stocks. Everybody thinks I'm crazy, but that will be the bottom, when it's just nobody wants to buy them. But I think we're a ways away from that, and we're just making that turn now to lower prices, and I do think we eventually get into new lower lows and a new bear market, but we're not there yet. The whole point of this Head and Shoulders top was that it would change this intermediate uptrend to transitional and now starting to move into a downtrend. And there's just one more chart I want to show you that's a little crazy. It's this one. So what you're looking at is the S&P 500 from this rally from October of 2022. A lot of people didn't believe this rally. They wanted to short it really early on. I fielded a lot of questions on the videos, is it time to get short and everything? And I'm looking at this market breadth and I'm saying, no way, this market is like rip roaring strong. And we just had the mega cap starting to rotate in here in January. But this white line is the percentage of NYSE stocks that are above their 200-day moving average. So if I take, hopefully I can get something close to it. Oh, okay, I'll use a pointer here. So if I take this pointer and you look at the percentage of NYSE stocks that are above their 200-day moving average right now, it is almost at levels that we saw here at the end of the bear market, right before we started to move into that uptrend. So S&P is way, way higher than it was back then, but we're seeing market breadth that is that bad right now. So the opposite of very strong here, very, very weak over here. And that's just telling us something, just like this was telling us, yeah, you don't want to be selling this market short over here in January, February, March. The market had a lot more to go, but we could see breadth starting to weaken over here. And now when you look at it, you compare it to these levels way over here at basically the tail end of the bear market. It's not looking good. Anyway, so I hope you enjoyed the video. If you liked it, please give it a thumbs up. That will help out the channel. And if you have questions or comments, feel free to leave them below. I always try to answer those. You can subscribe somewhere over here. There should be a subscribe link. And check out some of the other videos, some of the older videos to really see, what we're talking about when it was happening, when this top was happening. Just very rare for the market to suddenly change trend and not give you a warning. And those warnings are almost always a change in character or tone in the market. So enjoy your weekend, everybody. Hope you enjoyed the video. Thanks for listening.